On Saturday, Taiwan will elect a new president.
Results are over, results are out.
Javier Milei have been celebrating his victory in the presidential election.
Nayib Bukele has claimed victory in the presidential election.
The Bitcoin system is so perfect that I think it's going to be the future.
South Korea has a new president after former conservative prosecutor Yoon Suk-yeol.
Sure that the future of crypto and the future of Bitcoin will be made in the USA, not driven overseas. I will support the right to self-custody to the nation's 50 million crypto holders. I say this.
In 2024, there will be elections in at least 64 countries, and the U.S. election is the most watched. Since the U.S. dollar is the world's main currency, what happens in American politics affects markets and geopolitics everywhere. This year is especially interesting because it's called the Bitcoin election. Bitcoin is a big part of many campaigns. In South Korea, a candidate used Bitcoin in their campaign and won. In Argentina, a candidate did the same and won. In El Salvador, Bitcoin was made legal money, and the president won by a huge margin. But why? Is there a link between Bitcoin and elections? How does the U.S. election affect Bitcoin's market? We'll talk about this in the video. To understand the market during election years, you need to know about the election cycle theory. What is the election cycle theory? It's a theory that suggests market returns follow a pattern based on the U.S. presidential election cycle. This theory was created by Yale Hirsch, the founder of the Stock Traders Almanac. According to his theory, the stock market performs weakest during the first term of a president. It starts to recover in the second term, peaks in the third term, and weakens again in the fourth term or the last year. So based on the election cycle theory, the market doesn't perform well during the first and second years of a president's term, often experiencing a bear market. However, in the third and fourth years, the market performs much better, especially in the third year. Why does this happen? The theory suggests that in their first year, presidents tend to work to fulfill the interests of the groups that help them get elected. After that, they start to boost the economy to improve their chances of re-election. As a result, the market becomes more active and goes up. Another part of the theory is that by the third and fourth years, the president has already provided many economic boosts. Therefore, the first and second years need to slow down to control inflation, which can rise sharply. Policies then become more lenient in the third term to prepare for the next election. In 2016, researchers from Charles Schwab conducted a study analyzing data from 1933 to 2015. They found that the average annual increase in the S&P 500 was 6.34%. The data showed that the S&P 500 experienced a significant average return in the third year of a presidential term. Between 1933 and 2018, the S&P 500 had an average annual increase of 82% in the third year of a president's term, showing consistent data. From this data, we can see a significant rise in Q3, followed by Q4. This data is fairly reliable, though not 100%. No cycle exists in isolation. Other variables must be considered, such as black swan events like 9/11, the subprime mortgage crisis, and the pandemic. For instance, during George Bush's first term, there was 9/11 and the war in Afghanistan. Key points to note in the presidential election cycle theory. 1. Wars, recessions, and bear markets tend to happen in the first 2 years, while bull markets occur in the last 2 years. 2. The market performs better in election years when the current president is running for re-election. 3. The market tends to bull between August and October in presidential election years. 4. The market is generally stronger if the incumbent party wins the election. 5. This cycle cannot predict black swan events and must be confirmed with other cycles, like the global liquidity cycle or Fed policies. From the data, 6 results followed the presidential cycle theory out of 8 presidential elections since the Clinton era in 1995. Means the theory could be 75% correct. During Biden's first year in office, the market performed strongly, with a 39.44% increase thanks to a $900 billion stimulus in 2020 to combat the COVID-19 pandemic. In 2022, the market returned to a bear market as the Fed began tapering its stimulus programs. However, in Biden's third year, 2023, the market pumped up by 21.9%. During Biden's term, the loan money supply also increased sharply. More money was printed in 1 year than in the previous 100 years. It's no wonder Bitcoin's price jumped from around $9,000 to $69,000. When Trump took office in 2017, the S&P 500 index didn't perform well in 2018 and 2019, largely due to the trade war. Trump imposed tariffs on many Chinese products, which disrupted the global supply chain and affected economies worldwide. In 2019, the market was stimulated by QE4 in September, followed by several stimulus measures in 2020 to combat COVID-19. From Trump's case, the presidential election cycle theory seems valid. Now let's talk about Bitcoin during elections. Unfortunately, we don't have many data points to track the correlation between Bitcoin and elections since Bitcoin has only been around since 2009. However, with institutional adoption through ETFs, Bitcoin's performance might be more correlated with the S&P 500 in the short term. Now, let's see the latest survey about election. Grayscale conducted a survey about the 2024 election from April 30 to May 2, 2024, focusing on crypto perceptions in the political landscape. The survey found that 1 in 3 American voters became more interested in investing in Bitcoin and crypto following the approval of the Bitcoin spot ETF. The survey also found that 1 in 4 voters consider inflation the main issue in America right now. Additionally, 47% of voters plan to include crypto in their investment portfolios. Voters believe that crypto will create new jobs, increase transparency, and improve access to the financial system. 2 out of 5 people see crypto or blockchain as the future of finance. Interestingly, 3 out of 4 voters want candidates who are more up to date on innovative tech or crypto. By using a crypto or Bitcoin narrative, candidates should be able to secure at least 50% of the votes. This is further supported by data showing increased interest compared to the first wave of the survey. 7 out of 10 voters have investment assets and 1 in 5 owns Bitcoin. Voters say that inflation has made them interested in owning Bitcoin. I found an interesting trend. Since 2012, Bitcoin has performed well in the year before an election, the election year itself, and the year after the election. So during the 3rd and 4th years of the current administration and the first year of the new president's term, we can see this cycle in the election years 2012, 2016, 2020. And if the trend holds in 2024 as well, this means if we get a pump in 2023, we can expect another in 2024 and a final pump in 2025 before entering a bear market in 2026. During the second term of any administration, Bitcoin tends to underperform. So there's still more than a year left since this video was made. But start being cautious in 2025, especially in the middle of the year. Our pump has been too fast, and we've already started pumping even before the halving. From this data, there's something very interesting. During bull markets, Bitcoin always performs better than the indexes, even better than other asset classes. I would say Bitcoin is the best index ever, because its data is so reliable. If it's not at the top, it's at the bottom. There's no middle ground with Bitcoin. Unlike the S&P 500, which can be random, sometimes performing well, sometimes middling. From this point of view, Bitcoin is indeed the faster horse. One key to wealth is having a consistently faster horse, and Bitcoin has proven to be that. If this were a horse race, obviously we would choose Bitcoin over any other horse. Two 2024 is an election year. Plus, the market expects dovish policies from the Fed. As I mentioned before, increased global liquidity correlates with rising Bitcoin prices. Similarly, dovish Fed policies will also boost Bitcoin prices. However, there aren't many data points for presidential elections. Like other cycles, the past doesn't determine the future, but it does rhyme. Well, if you learned something new from this video, don't forget to click subscribe and like the video.